And we are still online, I think. So, sorry for the delay and good afternoon, everybody. My name is Pál Kolzsi and I am the president of the section of of finance at the Hungarian Economic Association, and we are the organizer of this online conference, I would say. I warmly welcome all the participants and speakers and the audience who are with us here. The title of our conference is a little bit long, but I think that it's quite interesting. What can we learn from the past, essentially from the 1970s, concerning the actual challenges linked to inflation, monetary policy, and the banking sector? That's a real topical question, I think, and it's a quite interesting in the field of finance. Our program, we had quite a lot of technical difficulties, unfortunately, and I hope that we can solve all these problems until the end of the meeting, but we still have some, but we are trying to do our best. So the program of tomorrow, of today, this afternoon is the following. We will have a short introduction and some thoughts and greetings from the Deputy Governor of the Magyar Nemzeti Bank, which is the Central Bank of Hungary, Barnabás Virág, who cannot be with us real time, but he sent us all the greetings he wanted. We will share with you his speech. That's something like 10-minute introductory speech and some thoughts about the conference and the topic that we are trying to analyze. And after that, we will have normally, according to the program, we should have 4 presentations. One from Laurent Ferrara, who is the full professor of international economics at Skama Business School, associate editor of International Journal of Forecasting and International Economics, former head of International Macro Division at Banque de France, and he will talk about the determinants of inflation and the role of central banks, lessons from the past oil shocks. This is the title of his presentation. The problem that he has some technical problems, but I hope that he can join our conference a little bit maybe later. We will see. The second presentation, or maybe the first, we will see, will be given by Eric Monet, professor at the Paris School of Economics and director of studies at the School of Advanced Studies in Social Sciences in Paris. He was awarded the title France's Best Young Economist by Le Monde in 2022, and the title of his presentation will be Disinflation Policies and Central Bank Finances in the 1970s. It's going to be a really interesting presentation, I am absolutely for sure. And he is already here and he could join the conference online, so we are happy to have you here, Professor. And after that, we will have 2 more presentations, one from Kristóf Lehmann, who is the director at the Central Bank of Hungary, and also he is the head of the MNB Institute at the Neumann János University. And he will talk about inflation similarities and differences between the 1970s and nowadays. And we will also have a presentation from Balázs Spéder, who is head of department also here at the Central Bank of Hungary, and he will tell us a little bit about inflation shocks and disinflation experience from the past 50 years. This is the title of his presentation. And after all these presentations, we'll have a Q&A session and everybody can raise his or her questions. You can unmute yourself or you can put your questions in the chat room of our WebEx application. So after the presentations, we will try to answer all these questions. So we are a little bit late because of the technical problems, and I'm really sorry for that. And I just would like to ask my colleague, and maybe we will have Lauren with us. It's a very great pleasure, I hope. So I would like to ask my colleague Zita to share the presentation and the speech of our Deputy Governor, Barnabás Virág. Please, thank you.
Ladies and gentlemen, distinguished guests and fellow participants. It's my pleasure and honor to welcome you today at the Economic History Workshop of the Hungarian Economic Association. Allow me to extend my warmest welcome to each and every one of you as we gather to explore the lessons that we can draw from the economic events of the 1970s. Thank you for joining us today. The importance of historical economics. In recent years, we have witnessed the resilience of our current central banking models and analytical frameworks during normal times. However, when confronted with abnormal, often non-linear events, these models tend to fall short in providing comprehensive answers to the pressing questions we face. We all know that crises usually bring about regime shifts, yet these transitions are often absent from the predictions of our pre-calibrated models. It's through the lens of history that we can discern structural changes, trends, and patterns from the different areas, offering us valuable insights into addressing contemporary challenges. Furthermore, the fact that major economic events are infrequent elevates the role of economic history in understanding what happened in the aftermath of similar occurrences in the past, such as central bank balance sheet expansions, episodes of very high inflation, stagflation, pandemics, or mass migrations. The comparative historical perspective provides us with distance from the present, drawing from the experiences of multiple systems. Economic history also serves as a testing ground for economic theories, contributing to the development of sound economic principles. Policymakers also consider economic history important during decision making, especially during the time of crisis. Of course, no single historical episode is a perfect template for current events. But when looking for historical parallels, for example, during the supply chain disruptions, it's useful to study the inflationary period after World War II and economic policies which contained supply chain disruptions and a spike in consumer demand after a period of temporary suppression. Just as well, if we would like to explore the potential consequences of an energy crisis on the price level, the 1970s can be a good comparison for the current economic situation. Let me quote Jean-Claude Trichet, former president of the European Central Bank, who noted that in the face of the crisis, we felt abandoned by conventional tools. We were helped by one of the areas of economic literature, historical analysis. Central banks and economic history research. These crises have also shaped the profiles of central banks. The focus and the growth of research and analysis departments within central banks are closely tied to their evolution from simple money issuing commercial bank function to the modern monetary authorities we can witness today. Concerning this evolution, I would like to highlight the importance of applied historical economic research in understanding the transformations of central banks. While central bank reports and statements typically give considerable attention to recent events of the past 1 or 2 years, there has been a noticeable scarcity of longer-term research spanning several years or even decades. The significance and the shortcomings of this gap are becoming increasingly evident in our present time. Let us contemplate, for example, the work of Baron Alexander Lamfalussy, the wise man of the euro, who gained worldwide recognition for his analysis of the Latin American debt crisis of the 1980s, an achievement rooted in the analysis of the historical perspectives. The individual experience of Lamfalussy intersected with the cyclical nature of booms and busts, motivated him to observe economic trends over extended periods. To cite another example, we can mention Ben Bernanke, former chairman of the Fed, who conducted his PhD research on the negative spillover effects of the banking crisis during the Great Depression studying in liquidity crunch and the real economic downturn. It was these historical insights that informed his innovative tools, such as asset purchases and monetary easing, which helped avert a complete economic collapse during the 2008-2009 crisis, leading to one of the longest economic expansion in the United States since 2010. Fortunately, many central banks have now recognized the significance of economic history research. While the most research areas have historically been macroeconomics, business cycles, economic growth, and monetary regimes, and financial stability, on the other hand, crisis, regulations, and central banks' lender of last resort role, pressing questions such as the nature of inflation, the impact of high debt, the nature of money itself, and different growth models will be soon incorporated into this range. In general, it is safe to say that adopting a pluralistic approach to central bank policy making offers significant advantages. Let me clarify that historical research does not replace the theoretical and empirical modeling and analysis frameworks of the central banks, but certainly complements them. Utilizing historical perspective in our analysis and research aids in selecting the right economic theories, allowing us to see the relevant patterns. Conclusion. I firmly believe that to succeed in this volatile decade, monetary policy needs to respond to ongoing and upcoming challenges appropriately. This highlights the importance of informing decision-making by historical experience as much as by economic theory. Today, we have an impressive list of distinguished speakers, so the opportunity is offered to exchange views on this topic. I wish to encourage a robust exchange of ideas and insights among the speakers and participants. It's my sincere hope that this event will be a resounding success, one that further deepens our understanding of the lessons the past holds for us as we navigate the complex economic challenges of today. Let me conclude by wishing you very, very productive discussions today. Thank you very much.
Thank you very much for the introductory thoughts for our Deputy Governor. So I also hope that, and I am absolutely for sure that this conference will be a very good occasion for deepening our understanding of historical experiences, as this is something which can be very useful in these complex and complicated times that we are facing right now. So as I mentioned at the beginning of that online conference, we will have 4 presentations, and finally everybody could join the meeting. And I think that we can go according to the program. So the first presentation will be given by Laurent Ferrara, who is a full professor of international economics, as I mentioned. His presentation will be shared by a colleague of us here at the Economic Association, and he is with us through his phone, because that was the only way he could join the meeting. But we are very happy to have you here, Professor. And we also hope that we see your presentation, and if we can also hear you, that is also a very we can hear you. So thank you very much for being here, and please, the floor is yours, and thanks for accepting our invitation. We are very keen to have your insights.
Okay, so thanks a lot, Paul, for this invitation. I'm very happy to be with you and to be part of this super interesting conference, and to come back to the world of central bank that I recently left. So apologize, because this is the first time that I'm doing this. I'm going to talk with my iPhone, and someone is moving the slides for me, so thanks a lot for this. So yes, during the 20 minutes, that I have, I would like to talk about a bit the lesson that we can have from past oil shock for the current economic situation, and especially focusing on the role of central bank in the propagation of those shocks. Okay, so first slide is indeed something that we are pretty much aware in this room, so that the world economy is facing now a high inflation rate after many years of low inflation for us. So what is interesting to keep in mind is that inflation was no more an issue for many economies, many advanced economies in the wake of the Great Recession, and suddenly we are back to this issue of inflation, and we realize that it is an issue. So if we look at the G20 economies on average, so I look at the inflation rate before the COVID in 2019. Inflation was about 5.5% on average, so including advanced and emerging economies. So it is a bit high, but we have a lot of we have emerging economies in this panel of countries, making that inflation is a bit high. So 5.5, and now in 22 it is 13.5%. So a huge increase across the board, and that's interesting. It is a global phenomenon. It's not only specific to some countries, except China. I was really surprised to see that China is the only country to have a lower inflation in 22 than in 2019, which is not necessarily a good news, in fact, because it reflects also some tension on production. So we had two waves, making that now we are where we are. So first of all, in the wake of the COVID period, so we have a stronger disequilibrium between, on one side, high demand for goods, high demand for consumption, and on the other side, low supply, because the supply chains were already, we had some halts, let's say, in the supply chain. So high demand on one side for good, low supply, making that we started to have inflation. That is, at the end of 21, inflation was already high in many countries in the world. And now we have a second event, that is the war in Ukraine, starting end of February, beginning of March 22. And this event propagates mainly to inflation, mainly through commodity prices, because as you know, and we all know, that Russia and Ukraine are big producer of commodities. So if you think about energy commodities, food commodities, industrial commodities, we saw a sharp increase in commodity prices, and then it seems to propagate to core inflation. So we have those two waves, making that we are expecting now high inflation. So the question now for policymakers and central banks, central bankers in particular, is the strategy that they have to carry out. So should we increase interest rate to fight inflation? If so, by how much we should increase? Until when should we keep high interest rates? So we have a lot of questions, and we saw that in fact it's not that easy to answer this question, and some central banks react quite rapidly after the shock. Some other central bank, it took a bit of time to realize what was going on, and so it's not an easy question. So if we move to the next slide, we see that in Chile, basically the main central banks, the Fed, the European Central Bank, and the Bank of England decided to raise interest rates. This is what we see on this graph. If you look at short-term central bank interest rate, we see that now we are basically at the pre-global financial crisis level, basically, okay, for all the three countries or areas, okay. The increase is relatively rapid if you look at the end of the chart. So what happened since the beginning of 2020 to 22, we have quite a sharp increase. So strikingly, only the Bank of Japan decide to not really move. So you see that the central bank rate is still at 0, but we know that Japan is in a particular situation of very low inflation for many years, and maybe having a bit of inflation is not that bad for the Japanese economy, but that's another story. But what I want to say here is that in fine, the decision was to increase the short-term central bank rates quite rapidly. Okay, let's move to the next slide. So if you look at the history, in fact, this is for the US, this is US inflation. This is not the first time in history that inflation is so high. In fact, looking at, we start after World War II, we have at least 4 or maybe 5 other episodes of high inflation. That is 2 episodes after World War II. The 2 oil shocks following the crisis in 1973 and the war between Israel and Arabic countries, and in 2079 the revolution in Iran, making that we had a surge in oil prices, making that inflation reached at that time 12% or even 15% during the second oil shock. Okay, so we in the US we experience inflation close to 9%, but in fact, what is interesting is that we can learn perhaps what happened during the 2 oil shocks in the 70s. They are a good benchmark, and that's quite interesting to focus on them and see what happened, because in a sense the context is more or less the same. That is an oil supply shock, making that energy prices increase by a lot, and leading to a recession, at least in the past. So we see that in the graph. So shaded areas that we see correspond to the US recession according to the NBER. Okay, and obviously the red bar, the red horizontal bar reflects the target, the 2% target that the Fed is supposed to have. So let's have a look at this. Okay, and let's move to the next slide. The next slide is in fact highlighting a stylized fact that generates a lot of literature. This is in this graph we see the real oil prices in the US. Okay, for WTI, accounting for CPI inflation in the US. So what we see is that each time we have a sudden and a large jump in oil prices, real oil prices, those jumps tend to be followed by US recession, again in shaded areas. Okay, so following this empirical evidence, we have a lot of papers, a large literature initiated by Jim Hamilton in his seminal paper in 1983, and other authors like Luz Kilian, Christian Baumeister, etc. So they focus a lot on this idea, showing that there is indeed a very strong relationship between the two. That each time we have an oil shock, this oil shock is followed by a recession. So the relationship is not that simple. Sometimes it can be highly non-linear, this relationship, not necessarily linear. So we have a lot of non-linearities in the stories, but we have something that seems to be a quite important pattern and a clear pattern when we look at history. But it's not that simple. If we move to the next slide, what we see is that if we simply plot on the same graph the federal fund rates, okay, we see in fact that each time we have an increase in the federal fund rates, the red line on the graph, we have also a recession following. Okay, so it seems that there is a story behind this, that the Fed rate can be possibly also a driver of the recession, meaning the idea that the central bank or the Fed here is likely to amplify the movement initiated by the oil shock and propagate the oil shock to the economy is something that is put forward in this paper by Bernanke, Gertler, and Watson in 1997 in the Brookings paper of economic activity. In fact, what is clear from this graph and from this story is that we have here a strong endogeneity issue. Okay, a clear endogeneity issue, and the job of macroeconomists and macroeconometrician in particular is going to be to disentangle between the type of shock. Oil shock on one side, reaction of the Fed on the other side, and leading to a recession just after. So if you think about the literature on structural VER models, this empirical literature, we need to have a very clear identification to be sure that we can identify the driver. Okay, who is driving this? Okay, so it's not necessarily the oil price, but in the middle, we have the reaction of the central bank that is likely to amplify the movement and to propagate the initial movement. And the lesson is very important for today, because if we are in line with this possible option, what it means is that the strong reaction of the Fed, ECB, Bank of England is likely to propagate the initial oil supply shock that we observe in the wake of the war in Ukraine, making that there is a risk of recession today, and this is more or less what we have in mind. Okay, so this is just for eyeballing the research question. And another point that I would like to highlight, that is also important for the story that we are facing today, is something that we find in the paper of Lutz Kilian in 2009, one of his most maybe famous paper in Econometrica, talking about the nature of the shock. In fact, the relationship between oil prices and economic activity depends strongly on the nature of the shock at the source of the increase in oil prices. In its paper, Kilian, in fact, disentangled three types of shocks on the real oil prices via a structural VER model: an aggregate demand shock, first, when the economy is doing well; an oil supply shock, typically what we had in the 70s and what we are having today; and something that is called a news shock, that is a shock of news, that is what is happening on market. Every time you have a news about supply or demand, this creates movement on oil prices. And in fact, the main results that he has are quite interesting, because he's showing that there is no clear evidence that oil supply strongly drives real oil prices. He's showing that aggregate demand has a medium-term impact after 3 quarters. And what is moving real oil prices is mainly the news shock. The news shock have an immediate effect on real oil prices. Each time we have a news, markets are reacting super rapidly, making that prices are moving up or down. So the lesson from this is that what is important to look at is the nature of the shock. Why do we see an increase in oil prices? Okay, and according to this, we can have different conclusions on the real economic activity, on GDP especially. Okay, so there is another. Let's move on to the next slide. Thanks. There is the literature, the initial literature by Bernanke, Gertler, and Watson has been. There is a focus on this recently, let's say. And there is a super interesting working paper by Miyamoto, Nguyen, and Sergeyev that I had the chance to discuss at the Banque de France conference quite recently. In this paper, they try to assess the role of monetary policy in the propagation of oil supply shock within the economy. That is exactly the focus of what we have today. And what is the idea they have? The idea is quite smart. At least on my side, the idea is to say, okay, now we have more and more period of zero lower bound, okay, following the global financial crisis. So we know that during this period of time, interest rate cannot move. So let's have a look at this period of time, zero lower bounds, and compare two periods, let's call them normal periods, during which the central bank can react, okay? So central bank can react during normal period and cannot react at the zero lower bound. And we compare the macroeconomic response to well-identified oil supply shock. Okay, we are talking about oil supply shock here, and which is why it is of interest for us. Okay, so they took a bunch of advanced economies, so Japan, US, ECB, Canada, etc. And they disentangle between ZLB, zero lower bound, and normal period, okay? And the main result that they have is the following. They show that, yes, indeed, monetary policy contributes to amplify the adverse macro effect of negative oil supply shock. That is, when monetary policy react, the macro effect is worse than when the monetary policy cannot react, that is, as a lower bound. So that's very important result. So there are maybe some caveats around this paper, but this is quite important for today and the monetary policy of today. Let me show you one example of the results in this slide. So what we see, perhaps for me, one of the very much impressive result of this paper is that we have the response, the impulse response function after stemming from a VAR model after an oil supply shock for the US. So in blue, you have the response during the zero lower bound, that is when the monetary policy cannot react. And in gray, you have the monetary policy, the response when the monetary policy can react, when there is an increase in the interest rate. And you see that you have a huge difference, okay? When monetary policy is reacting, this generates a drop in economic activity, while you don't have this kind of drop, okay, during the ZLB, okay? You even have something slightly positive, okay? So that's a very interesting result for the US. For the euro area, if you go on the next slide, yes, thanks. The result is more or less the same, less impressive because you don't have this huge monetary policy, huge positive impact at the zero lower bound, but you see that you can disentangle the two periods. Okay, the effect is negative during normal period because the Fed, in that case, the ECB, sorry, increase in interest rate, while it is relatively neutral at the zero lower bound in blue. Okay. But you will let me know when I have still 5 minutes, or how much time do I have?
Go ahead. You just take your time. That's you have something like 5-7 minutes, something like that.
Okay, perfect. That's perfect. Thank you. Okay, so the question is also, okay, the effect on GDP is negative. Something that we could expect if you believe in this Bernanke et al. Paper. Something that we can have in mind. But what is the effect on inflation? Okay. They look at two variables: CPI, okay, consumer price index, and also inflation expectation. This is for the US, this graph. And what is striking here is that, in fact, in both cases, we do not see the difference in the cases. That is, when the Fed is reacting or not, inflation is going down progressively without any difference. You know, we cannot disentangle the blue and the gray line for both CPI on the left and for inflation expectation according to the Michigan survey on the right. So that's a bit striking. Okay, there is no evidence of an impact on US inflation. So if we go to next slide, what do we have? We have that rise in interest rate following a oil supply shock is likely to negatively affect GDP compared to a no-move hypothesis, right? Without providing additional support to high inflation relief. That's the point, because we could imagine that when we are increasing interest rate, this could be a way to decrease inflation more rapidly than without a no-move action. This is not the case. Okay, so it seems that if we do a cost-benefit analysis, the cost seems to be higher than the benefit, because we don't see any benefits on inflation. Okay, so if policymakers and central bankers in particular believe in this kind of result, then the major issue is in fact to be able to identify in real time the source of the oil price increase. Okay, if we are facing a supply shock, in that case, if we believe in this literature, there is no point, in fact, to tighten too rapidly and too strongly, but could be worse to have a kind of wait-and-see approach and wait a little bit. But if it is a demand shock, in that case, we have more consensus in the literature, so we kind of agree that in that case, if it is increase in oil prices due to demand shock, there is more consensus on the fact that monetary policy tightening might be useful under some conditions. Okay, that I cannot discuss here, but we have more consensus on this view. Okay, so the story comes back to are we able to identify in real time an oil supply shock versus an oil demand shock. Okay, so let's move to the next slide. Thanks. So what about the recent period? Let's think about the US. Okay, if you look at the recent period, data tend a bit to support the view proposed in the Bernanke et al. Paper and the paper that I mentioned recently. That is, we had a rise in oil prices without no so far subsequent recession. Okay, after the rise in commodity prices in Ukraine. Following the war in Ukraine, sorry, we did not observe in the US any recession. But now that the Fed is tightening its monetary policy, the probability of having a recession in future months is increasing. Is increasing by a lot. And the question is now, is the Fed able to manage a soft landing? Or are we going to fall into a recession, which is, by the way, is perhaps the only way to have a decrease in prices, to have a deflation and to go back to previous level. Okay, so let's move on to the next slide. Well, this is what I mentioned. I'm going to skip this. Okay, so the question now for central bankers is, as I said, what is the contribution of supply and demand shock to this increase in oil prices? Okay, are we able to identify the shock in real time? We have tools now. We have tools. We can identify. Some people are trying to identify supply shock by looking at newspaper. If you look at a large amount of newspapers and news, if you do some natural language processing, text mining approaches, you can identify if perhaps you have a supply shock or demand shock. An alternative is one of the work that we did recently with Simona Delle Chiaie and Domenico Giannone, is to try to identify demand in real time. Okay, we look at a bunch of commodities and we say, okay, if all the commodities are moving in the same direction, it is likely to be a demand shock. Otherwise, I don't know what it is. So we have an index, which is a kind of factor, a global factor over a large database of commodity prices. In fact, we take the IMF. The IMF has a nice database of commodity prices available on a monthly basis. So each month you can estimate the common movement in all commodities, and this common movement is supposed to reflect demand. Okay. So when we update, in fact, the data are updated until 22. Okay, end of 22. What we see is that, in fact, we had a drop in the demand, a clear drop in the demand. You see that the index is quite low at the end of the sample, meaning that the demand side in this commodity, this increase is quite low. So What does it mean? By a mirror approach, if the demand is low, it means that the supply is high. Okay, so it seems that we have tools to identify in real time if we have a more oil supply shock or oil demand shock. And the lesson from what I have seen in the literature is that if we identify oil supply shock, in that case, perhaps it's not necessarily a good idea to tighten too rapidly and too strongly the monetary policy, because there is a risk of drop in GDP without a clear impact on inflation, which is the main reason why central banks are now increasing interest rate. Okay, so perhaps, Paul, let me stop here. I still have a few slides, but I basically said what I wanted to say to you. So maybe we can discuss during the discussion about the other issues. Okay.
Okay, thank you very much, Laurent. I think that we can all agree that all these non-intuitive results and takeaways from central bankers, that is a good start for such a conference, I would say, because it's really non-intuitive sometimes. Okay, we can at the end of after all the presentations, we will have the Q&A session if it's okay for you. I have already some questions, but let's wait the other presentations. So the next one will be given by Professor Eric Monet. Monsieur Monet is here with us, and I hope that you can share your presentation. But if you have any problems with that, we can also share for you. But we will see. But unmute yourself, because otherwise we cannot really hear you. You are muted now. We see your presentation, but we cannot hear you, unfortunately. It's a little strange because we did a voice test and it worked.
Can you hear me now?
Oh, that's all right. Okay. Now it's okay.
Yeah, I didn't know. Nothing has changed. So can you see my screen? Can you see my screen?
Yeah.
Yeah.
Okay. Yeah, we can see your presentations. But it's not the full screen mode, but we can see it.
No, it's good. It's moving. Okay. So thank you very much for the invitation. Indeed, I continue to discuss what we can learn from the 1970s and 1980s. Although the theme of my presentation is a bit less, I would say, central to the main policy discussions we have right now. I mean, I think most people are definitely interested in how to bring inflation down rather than in what's happening in the central bank balance sheets. But that's, I think, for central bankers, I guess it's still quite interesting to know what happened to central banks during the period of high inflation of the 1970s and then disinflation of the 1980s. So the question we ask in this paper, which is written with Theodore Human and Chris Michener, is whether central banks made losses or profits during the 1970s and 1980s, during these times of where there was very high volatility, as we have just seen, as Laurent just reminded us. There was very high volatility in prices, in interest rates, and also in exchange rate. So what was the impact for central bank finances? And the motivation for this question is obviously that currently, since central banks have started to rise interest rates, it has been very strong consequences on their finances, on the profit and losses. You might know that, but most major central banks that have increased their interest rates in the last year experience quite important losses. And according to all computations, these losses are expected to be even higher in the at least 2 or 3 years to come. So this question on whether disinflationary policy, so meaning rising interest rates, are necessarily linked to central bank losses as we have here in the public debate, and also on the fact of the second question is whether these losses, central bank losses, have important consequences. So you can see here a few press clippings that show that actually in the financial press, this is in political debates. I mean, this issue of central bank losses has received quite a lot of attention now. Many people think that central banks may lose their credibility, and as a newspaper by a paper article by Politico said, central bank may face a credibility crisis because of this financial losses. So the two questions we ask here are very simple. Is first,
Sorry.
what did happen? Yes.
Yeah, no, your presentation. We see all or the same. The title page or the title slide.
Okay. Sorry.
It didn't move. Sorry.
I don't know why it's not moving. It's moving on my screen, so it's not moving on your screen, right?
No, not really. But maybe like that it will move.
So now I left.
Yeah, we are. Yeah, that's okay. We are in this with these titles of the newspapers.
Okay, good. So you can see the titles of the newspapers. I mean, I selected a few of them here, just to show you that indeed, at least in the financial press, but also sometimes in the public debate, and there was this example in Germany of the German audit office that warned that if the Bundesbank was facing losses, this will need recapitalization. So, and it's more generally linked to the idea that indeed central banks may face severe issues because of the losses. So the two questions we ask in this study is first, do rising interest rates necessarily cause central bank losses? And it's here that it's very interesting to look at the 1970s and 1980s, because we had, as Laurent has explained, I mean, this very stark rise in interest rates, which is very unprecedented, at least for Western advanced economy, US, Western Europe, Japan, or North America. And the second question is, if there are any losses, I mean, are these central bank losses a problems for monetary policy and central bank credibility? So quite strangely, I mean, you might wonder, why we did that and whether we are the first to do that. But quite strangely, there's never been any study, as far as we have seen, on central bank finances during the Volcker shock, so during the very strong rise in interest rates. So there have been recently quite a lot of literature on central bank losses, but everything focuses on data starting the early 1990s. So clearly, I mean, we didn't know. I mean, there was no economic history study on the consequence of the high inflation of the 1970s and the Volcker shock, so the interest rate increase of the 1980s, on the finances of central banks. So this is what we decided to do, to conduct this study. And the main findings are the following. So first, contrary to today, we find that actually central banks made a lot of profits during the 1980s when they increased interest rates. So this is completely the opposite as today, the reverse. And we will explain why. And the reason why, I mean, why central banks made profits in the 1980s but are making losses today is due to two factors. The first one is that today central banks are remunerating reserves, so they pay interest rates on reserves of commercial banks at the central bank. This is one reason. And the second reason is that central banks today, as we know, I mean, have purchased a lot of long-term bonds at very low rates, which create a maturity mismatch in their balance sheets. And these two factors did not exist in the 1980s, first. And the second thing, which is interesting, that these two factors need to be combined to generate losses. Okay, that we will run a large number of counterfactuals, and we show that even if in 1980s central banks had either done one, so either paid interest rates on reserves, or two, which is whether they have did quantitative easing before with buying long-term bonds, this will not have been sufficient. So you need the two to be combined to generate losses. And this is actually what is happening today but has never happened in history. So this is actually, in that case, I mean, the comparison with the 1970s and 1990s show that actually the current period has no historical precedents. Then there are some historical precedents, nevertheless, for central bank losses, because central bank losses did not occur in 1980s because of an increase in interest rates of central banks, but it did occur in 1970s for a different matter because of losses of foreign exchange reserves. Okay, what is Switzerland is experiencing today, but not the ECB, not the Fed. I mean, these central banks are experiencing losses because of increasing interest rates, not because of FX reserve losses. And what we show is that when these central banks, especially the Bundesbank and the Swiss national banks, experience losses because of FX reserves in the 1970s, this did not apply recapitalization, and actually it generated no problem at all. I mean, the central bank just carry over their losses, and it was not, it did not engender, it did not it did not involve a credibility crisis for the central bank. So the implication is first that the first conclusion of this study that central bank losses are not a necessary consequence of anti-inflationary policy. So in history, I mean, the most important anti-inflationary central bank policy of the 1980s did not lead to central bank losses. This is something which is very specific to our time. And so it means that central banks really need to justify their losses today by the fact that they want to pay interest rates on reserves and that they had conducted this quantitative easing in the past. So I think this conclusion is important in our mind because for the way that central banks need to justify their losses. I mean, in this way, they cannot look at the past, but need really to justify what has been done in the very recent years. A second implication is that because losses, as we will show, is mostly result from maturity problems, these losses will vanish after a few years, which is consistent with other recent studies that show that the current losses of central banks may not last very long, but still they might be very important during at least 2 or 3 years. As I already said, I mean, central bank losses do not imply central problems for central banks, but they require that central banks could explain very well why they're making these losses. And today, this is really due to reserves, paying interest rates on reserves, and having conducted large assets purchases during the previous years. So now starting the study in itself. I mean, the first things, just to be sure we are all on the same page, is just a reminder of why central banks can make losses. So the first potential reason for loss is a default of the borrower or the asset issuer. I mean, if the central bank has bought asset of a company or a country, and this country default on its public debt, then central bank is making losses, or the central bank has lent to a bank and the collateral is not good enough, then it's making losses. This is the most straightforward way, which actually has almost never happened in history. The second reason, if central banks are selling assets at a lower price than the price at which these assets were purchased, which is actually what the Bank of England has done recently, but it's very rare also. I mean, it's been very specific to England in the recent past. And third, the other possibility of central bank losses is a depreciation of foreign exchange reserves. And here it's very important to note that foreign exchange reserves are not valued in the same way in central bank balance sheets. I mean, domestic assets are valued at book value. So if the central bank does not sell the domestic asset, there would be no loss for the central bank. Whereas for foreign exchange reserves, they are valued at the market value. So if there is a change in the price of the asset or in the exchange rate, then it has the consequences for central bank finance. So this is why actually in most history, past, I mean, old history or the recent past, most of central bank losses occur because of foreign exchange reserves. And the fourth reason, which is the one that we're facing today is a mismatch between returns on assets and the cost of liabilities. I mean, it's very simple, is the fact that central banks have bought bonds that earn 1% or even less than 1%, but they have to pay an interest rate of 4% on their liabilities, on bank reserves. So this mismatch between 1% on the asset side, of the return on the asset side, and 4% on average on the liability side generate losses. Okay, so all these are possible reasons for losses, and the question here is that today we know that this is the fourth reason, which is most important. I mean, the third reason is still important for countries who have foreign exchange reserves in many emerging markets and also in Switzerland. But the fourth one is important, but the one and the two also can happen. So we were wondering what happened in the 1980s, whether the Volcker shock, so the increase in interest rates, could generate any losses through any of these four mechanisms. So just a reminder, you can see on this graph that indeed interest rates increased very rapidly during the 1380 after Volcker. So this is on the average interest rate for 10 central banks that we managed to get in our sample. So we've got mostly a European central bank, or as well as the Federal Reserves and Australia. So this is the only central banks for which we could really have very detailed information on the profit and losses accounts. This is why we had to limit our study to 10 central banks. So now the main results is that if you look at the average of any indicator of profitability, so it can be, for example, the return on assets here, I can show you other later, you see that on average, the return on assets was quite sizably larger in the 1980s and in the 1970s. So the fast increase and large increase in interest rates did not indeed create losses or negative equity for central bank. I mean, you can also see that central banks, the strengths of, I mean, the central bank's finances strengthened during the 1980s because the average equity to asset ratio also increased in the 1980s compared to the 1970s. So what is interesting about during this period of the Volcker disinflationary shock, indeed disinflation was achieved through an increase in interest rates, but not through a decrease in central bank balance sheet. Okay, so you can see here that the total assets in nominal terms, they increased clearly during the 1980s. And also, if you scale these total assets by GDP, is really stable. Okay, so it shows what I think now central banks have accepted, is the fact that you can run disinflationary policy without having to decrease the central bank balance sheet. Okay, which also already explained a little bit why central banks did not make losses during this period, because they did not sell any assets during that time. Another indicator of central banks' profits is the fact that indeed the revenue transfer to the state was higher, increased again on average in 1980s for all of the central banks, which is something as well which, as far as we know, has never been discussed in the literature. But I think that it's pretty clear that actually during the Volcker shock, central bank generated revenues for the state, which is not very big, but it's not completely small either. I mean, it was it reached 0.3% of GDP during this period. So if you think about, for example, 3% of GDP deficits, this is not completely a minor issue. So I think I can skip this one. So another interesting thing, which is, I mean, if you're really interested in the operations of central bank, I think it's important to understand what central banks did during this period, because it's also had consequences to understand what happened to their finances and what they eventually did profit. Is the fact that so during this period, central banks did not pay interest rates on the reserves of commercial bank at the central bank. instead they increase obligatory reserves, meaning the percentage of deposits, so the deposit that commercial banks need to pledge at the central bank. So these obligatory reserves increase during this period, but the consequences of that is that the total amount of reserves of commercial banks at the central bank decreases. Okay, this is a bit paradoxical, but it means that actually when central banks increase obligatory reserves, since these obligatory reserves are not remunerated, this is actually a tax for commercial banks. So the commercial banks, they will do whatever they can to take their money out of the central bank. So this is the reason why actually reserves decrease during that time. It's really linked to the fact that reserves, there was no interest rate paid on reserves. And this is why actually it's something that we don't see today in central bank. So now we are interested in trying to explain further why central banks did not make losses during this period and why this differs a lot from today. So to do that, we run simple counterfactuals. And the first one is to try to simulate whether central banks would have made losses if they had remunerated reserves as today. So if they had paid interest rates on the reserves of banks at the central bank. And it's quite striking here to see that this had very little effect. Even if you increase the interest rate paid on reserve in very large amounts, so if you increase it to the same level as the interest rate of the central bank on loans, for example, that was applied during this period, so which was on average around 13%. So even if we increase the interest rate paid on reserve to 13%, this does not create losses for central bank. And even if we also increase the size of reserves in the central bank balance sheets, which are here the graphs in the bottom. So if you see that it becomes dark blue when we increase the interest rates paid on reserves, so it's getting closer to zero. So zero would be when it's zero, there will be no profit for the central bank. So it's getting closer to zero than the blue line, but it's still not it still does not generate losses. So to generate losses in our counterfactual, you have to merge the remuneration of central bank of reserves at central bank, and also to change the maturity of the asset side. So if we change the maturity of the asset side of central banks in the 1980s, and we increase the maturity of the asset side in a way that is similar to today, so which is around 7 to 8 years today. So most of central banks held government bonds with a maturity of 7 to 8 years, while in the 1980s it was very different because they have made no quantitative easing before. So for most central banks, actually, it was still between 3 months and 6 months because central banks were not buying long-term bonds, but mostly discounting commercial paper. So there are no problems of maturity mismatch between the asset side and the liability side. During this period, during the 1980s, the central banks that had the longer maturity on the asset side was the Federal Reserve, which had a 3-year maturity on average. And even for the Federal Reserve, which already had a longer maturity, there is no change. It's only when we combine interest rates on reserves and a change in maturity up to 8 years that we can generate negative profit, as you see on this graph. So before I conclude, I mean, something I already said in the introduction, but so it's pretty clear that there was no central bank losses because of the disinflation of the 1980s for the 2 reasons that I have already highlighted. But there have been central bank losses in the 1970s because of foreign exchange reserves. So it's straightforward that in the 1970s there were two devaluation of the dollar in 1971 and 1973. So when the dollar devalued, the value of dollar reserves in domestic currency decreases. So it was a depreciation of the reserve for the central bank, and it generated losses. So the central banks that held larger part of dollar reserve during this period, especially the Bundesbank and the Swiss National Bank, experienced quite large losses that you can see here. For the Bundesbank, in the 1970s, many times they experienced losses up to 5% of the total assets of central banks. So it was very sizable. It was not. It was a bit like today. And you see that these losses, I mean, they were repeated several times. Okay, so at the end it was a temporary losses because they did not last forever, but it was repeated during several years. And it was not a problem for the Bundesbank. I mean, they did not imply recapitalization by the government. They just carry over losses and just explain that these losses were really due to the foreign exchange policy of the central bank, which had been done in cooperation with the government, and the central bank was fully legitimate to run this foreign exchange policy of a very strong Dutch mark at this time, or so strong Swiss franc. So there was like an agreement between the central bank and the government and even the parliament that these losses were consistent with the main objective of the central bank. Okay, so our main message here is that as long as the central bank is able to justify it, the losses are consistent with the objective of central bank as well as the government, then central banks do not need to care about these losses and just need to can carry over the losses without recapitalization. So in conclusion, you have seen that the anti-inflationary policy today are very different from those of the 1980s, and they have very different consequences on central bank finances because the operational framework of central banks today is very different because of this interest rate paid on reserves, which is completely new. I mean, it did not exist in the 1980s, but also because of the legacy of the quantitative easing. So it's really the two factors that matters. It's not only one, it's really the combination of the two. So paying interest rates on reserves and having bought so many long-term bonds before. And I think this is very important and here that the historical comparison is important because then central banks can really adapt their communication justification to the current events, and not, for example, say that any kind of anti-inflationary policy will generate losses, which will not be true here. But I think the other reason why it's very important for central banks to communicate on that and rightly communicate is that also they need to pay quite a lot of attention of the impact of this interest rate paid on reserves on the potential profit of private banks, because again this is completely new and central banks have to take that into account today. And the other consequence is that because it's today a maturity mismatch, central banks are likely to be temporary. And last, I mean, if we compare to the past, there's never been central bank losses for the same reason as today, but there have been central bank losses because of foreign exchange reserves. And even in countries like the Bundesbank, which has a very independent central bank in the 1970s, these central bank losses were fully manageable and did not create a credibility crisis of a loss of independence for the central bank. Thank you very much.
Thank you very much, Eric. It was really interesting. We can say that we are after two very actual and relevant presentations. All the questions that you mentioned and you raised are really in the heart of the debates of the central banking community. So let's move to the presentation, the third presentation, which will be the presentation of Kristóf, our colleague here at the Central Bank of Hungary, and also he is the head of the MNB Institute at the Neumann János University in Hungary. So the floor is yours, Kristóf, please.
Thank you very much. May I ask for a bit of help with the sharing? All right. I see Webex. Okay. Yeah. I don't know whether you can see.
Yeah, we can see it. We can see your presentation. It's not full screen, but we see it.
Yeah. But I just.
We have to switch. Yeah.
Switch, yeah.
It's kind of. We see it, so you can
All
start
right, perfect. Okay, so thank you very much for the invitation. I'm very happy to be here and discuss our view about the 1970s. Me and my colleagues really did, from several aspects, deep dive to the 1970s. And basically, there will be soon a series of articles be published about what we have found in basically 2 different projects. And the third project will be presented by Balázs in the coming sections. So that's a way more technical part of the findings. But the other project was from the practical side, I would say, and the policy side. So sorry for that. I will not be that technical, but maybe there will be some very useful ideas in the comparison and looking at the 1970s from the monetary policy and I would say economic policy point of view. So looking in the mirror of the 70s, that's the title I give to the presentation. And of course, the necessary disclaimer that anything I say or miss is not the fault of the Magyar Nemzeti Bank. Let me start with the similarities, and I will shortly come to the conclusions and the monetary policy or economic policy lessons we found. So let me start with some similarities. The number one is basically both decades, the 1970s and the 2020s, are filled with some sort of tensions in the geopolitics sphere. If someone remembers rightly, the 1970s and the oil shocks started with sanctions and basically the OPEC's policy to use the cartel pricing policy and pricing power, and that was extremely effective during that time. And basically, it resulted in enormous increase in the oil prices that in the previous presentations you could have seen, and even in the current presentation, I will show it in slides. The current geopolitical sphere is also filled with lots of sanctions, and protectionism is increasing all around the world. And definitely this has some very similar price reactions or results in some very similar price reactions as the geopolitical moves in the 1970s did. Also, we have to tell that it's not only the sanctions and not only geopolitics, but of course the COVID afterwards and effects were also very important in the price actions, also in the consumer prices and also in the commodity prices. So it's a really very complex situation that we are facing in the 2020s, just because of the reopening and the sanctions and the COVID effects coming together. Basically, what we have seen is very similar price actions, and it's not only there for oil or energy-related commodities. If energy prices are increasing, definitely there is a very strong spillover to other sort of commodities, and that's what we have seen in the 1970s as well, and that's what we are currently seeing in the 2020s as well. Of course, the price actions of the oil market were extremely significant in the 1970s, and basically there were 2 price shocks that definitely made these supply shocks extremely prolonged and very effective in this spillover process as well. What currently we see basically in the 2020s is similar. The the picture or the graph here is not showing everything, but I think I will have some graphs later on. But basically, the gas prices or natural gas prices, oil prices, even agricultural food prices, industrial metals, and even precious metals increased in price since 2021. And if you just look at the current articles, we see that diesel prices are increasing, and at least in Europe there is a strong shock and a very strong issue regarding the diesel coming from the lack of refineries, meaning that basically there are new and new waves coming from this commodity and energy price shock, even in this decade. So basically, we are currently in a bit more than 2 years long commodity price shock, and we do not see the end of the shock, as all the geopolitical issues are very dynamic, meaning that there might be further waves coming, and it's very difficult to plan in this sense. And I think this is also a very important note here, because this is also a similarity, because it was very similar in the policy examples as well in the 1970s, which I will later go into details. So here is a price chart for different commodities and different parts of the inflation, some sub indices in the United States of America. And in this sense, you can see that basically there are a few titles or items where the price shock is very similar in levels to the 1970s price shocks. Of course, we do not know whether it will be that prolonged or this will be transitory, as it was communicated for quite a long time from central bank's point of view. However, currently we see, of course, some sort of downturn in the prices and in inflation sub-indices. However, there are some issues that may suggest that at least in some commodities a prolonged issue may come up. However, and this is the, I would say, more positive side of it, there are major differences among the two decades. Not all are positive, I would say, but definitely there are a few one which are definitely on the supportive side for the decrease in inflation, however, or disinflation. However, there are some issues that are very dynamic, and just based on the past few years, I think may give some concerns or show some difficulties in the global processes. Let me start with the question of globalization. So the current world economy is very different compared to that of the 1970s, as basically the financial flows, the economic flows, world trade is at a really different level than it was in the 1970s. The question, which is new, I think, in the 2020s, is whether this level of globalization can be maintained or it's sustainable, as we see several moves from different sides of the world, started with the trade war, and now we see way more protectionism kind of moves, and also lots of sanctions that are definitely moving against globalization. Another very important change or difference, I would say, is the demographics. And it's a very important structural thing when it comes to main or the most important economic questions. I would say the number one issue is that the 1970s was an era when the working age population was increasing quite dramatically or significantly, I would say, in the 1970s in most of the developed countries. And the situation nowadays is totally different. Actually, the working age population is decreasing, and now it's a longer-term trend. And the other very important point regarding demographics is that the dependency ratio is increased compared to that of the 1970s. This together means that basically less people will have to finance more people who are inactive, I would say, and this definitely raises several questions regarding the fiscal balance projections, regarding tax policies, regarding savings, etc., which are also very important when we do these economic policy comparisons. Another issue which is very important and I think definitely worth several studies is the trade union membership, which was very strongly analyzed in the economic literature. Basically, in this sense, we are in a totally different era than that of the 1970s. Basically, it was 2.5 times higher level of trade union membership, meaning that the bargaining power of an average labor or an average employee was way higher in the 1970s than currently. In this sense, we believe that the similar supportive argument for a wage price spiral is less likely to be correct. It's of course very important to look at wages and wage dynamics. However, it's not only about wages, and just based on the trade union issues, we believe that even if wages are important regarding the price movements, we believe that it's it should be just one factor of the story and not the main factor, as some papers suggesting in the 1970s. Another very important issue is how the energy intensity of the economy changed. And in this sense, I think there is a major positive development that basically the energy consumption per unit of real GDP is way lower than in the 1970s. Of course, it's just one point, as when we come to issues like the climate change and these sort of challenges of policy, we have to basically conclude that not much changed in the energy distribution or the energy use of different type of energy sources, and the fossil part of the energy sources are still very dominant, and unfortunately the renewables increase their share. However, this is mostly in nominal terms and not in the share of the total usage, meaning that we are definitely looking forward to new technological solutions and more efficient usage of renewables, basically to deal with the sustainability issues from the climate side. And the other very important difference, I would say, is the pricing power, or related the pricing power. the United States shale oil industry became very important, and also the level of the SPR of the United States of America also became very important. And together, these two and the usage of the SPR definitely decreased the pricing power of the OPEC or OPEC plus countries. Here we have to mention that the dynamic decline in the SPR is showing that, of course, this is a tool only for a limited time, and definitely it works like an FX reserve for an emerging country in this sense. But definitely it was a very useful strategy, and shale oil and the production of shale technologies in the United States of America definitely are making the world market or the world production in a different structure than it used to be in the 1970s. So let me come up with some monetary policy related issues and examples. A few countries I would like to highlight, starting with West Germany, which was, based on our research, one of the best behaving countries, and its central bank really did a great job, both in the first and in the second oil shock. They reacted very sharply and on time, I would say. And their policy mix was very effective. As you can see, basically during the first and the second oil shock, they did not end up in two-digit inflation rates. And in this sense, they were very effective with trying to maintain and price stability and fighting against the higher rate. The example of the United States of America was a bit different. They were, I would say, based on the issues, a little bit more cautious, I would say, with the increase of the discount rate, and finally with some ongoing issues. It was the 1980s where very effective policy steps and very sharp policy steps had to be made. During the 1970s, it was Arthur Burns, and his policy idea was that it's mostly a wage issue, and it's basically the trade unions that somehow have to solve the situation, and trade unions should be controlled with the bargaining power. And he held that basically it's not an issue for the Fed. In the starting of the second oil shock, the current or the that time leadership of the Fed thought that it's a transitory effect that's going on, and therefore they started also cautiously with the hikings. This transitory word is a little bit similar that we have heard in the 2021 era from many central banks. However, fortunately, it seems that the two situations, at least how we see it now, are different. The end is the Volcker story, which I think most of us here knows. Rates were increased sky high and hold there for a prolonged period. And after that, with I think a very huge shock and huge cost, inflation was decreased by the central bank. Another issue is the UK, and in this sense, I think we have to look at a little bit higher distance or further. This is not only an issue about monetary policy, but also about the fiscal policy. The monetary policy had some issues, and I would say that in the base rate, it did not went that far that it could have went. However, the 1970s fiscal policy side, as we found, was quite strong in stimulus, and that resulted in extremely high inflation, above 25%, and a new very high wave, above 20% in the second shock as well, suggesting that it's not only monetary policy, but the cooperation of the two policy sectors are very important. And finally is Japan, which was in a very strange situation in the early 1970s. There were some international exchange rate related terms that were just agreed, and they had to deal with basically supporting that exchange rate agreement as well in their policy, meaning that they had to weaken the yen. And after that, when the oil shock hit the economy, they were a bit hesitant in the monetary policy due to the relative strength of the Japanese yen in their evaluation. And the end result is or can be seen in this chart, also very high inflation for a relatively prolonged period. Let me come up with some policy challenges that we see currently or in comparison. Number one is that the situation on the fiscal side is very different, or the public debt side is very different in the 1970s and in the current era. I have read many papers and articles about the 1968 programs in the United States, how strongly it affected the budget deficit. But basically what we are talking about is 1 year lower than 3% to GDP fiscal deficit. And currently, as we see in the case of the United States of America, it's between 6 to 8% also in the coming years, according to the IMF's forecast. And the big issue is the debt level, the stock, as it is a very different situation that basically that time when the first oil shock hit the US economy, the nominal debt level was $500 billion, and that is currently 33 trillion US dollars. The level is extremely different. Also, the real growth path of the Western or developed countries was very different. I would say generally around 4% real GDP growth was something that was a general average, I would say, for these countries. Of course, when the shock hit the economies, there was a recession. However, the normal time growth levels were way higher than they are currently. Why is it important? Just to come up with how we can deal with debt sustainability. If we just take the general economic or textbook related dynamics and how the sustainability of the debt to GDP ratio can be maintained, then basically it's a very simple issue regarding how the implicit interest rate of the government debt relates to the nominal GDP growth. And of course, nominal GDP growth comes from real growth and inflation. And in this sense, it's a very easy issue to see when we should have a primary deficit or when a surplus is needed. From the literature, a very important suggestion is that the initial debt to GDP ratio is a key among these variables. And this is why it is a very important point in time currently, as the longer we have this higher for longer narrative from the central banks, the average interest rate of the government debt is increasing, and definitely increasing the implicit interest rate on the debt. This is a repricing, and it's very important because the debt service will increase. Now the comparison is here. You can see how strongly the numbers are differing in the Western countries. Basically, it's except Germany, every country has a 3-digit debt to GDP ratio, and a repricing of the debt level and the debt services, definitely suggesting a very different era. Why is it different? Because there is a certain level of the interest rate or the longer term yields where the system can get until it gets to a level where basically it's not sustainable. Another issue which is definitely very important for decision makers is the financial stability issues. It's not only the public sector debt level, but also the private sector debt level that is definitely holding some sort of financial instability risks. Therefore, cautiousness is very important. And also asset prices, due to the financialization, there are lots of relations and direct ties in the economy to certain assets and asset prices. Therefore, this whole structure in the finances or the financial system are tied together, and it's very important how the decision makers can find the right way out of the difficulties. And one final issue here regarding the lessons, I would say. In Hungary, for a very prolonged time in the 1970s, price controls were used as a tool to basically deal with or fight against inflation or the increase of inflation. Now, basically, the end result based on our findings was that there were lots of inefficiencies in the system. And in the 1980s, but basically in all countries, there was a very remarkable disinflation. Inflation was near the top level in Hungary. And that was the story during almost the whole 1980s, meaning that price controls may be a very effective tool, but definitely not for a long term, just for a transitory time, as it became extremely pricey and definitely will have a lagged effect as well to the economy. So just to conclude, several lessons from the 1970s. Those countries, what we see were in the economic policy mix, I would say successful, did a very strong monetary policy reaction, but also fiscal policy was supportive as well. And it's a very relevant issue, because if the fiscal policy is doing the stimulative policy with very high fiscal deficits, then monetary policy cannot be an effective tool in such a high inflation era. So the perfect coordination is needed. It's especially needed because the situation on the debt level, both in public and private sector, is different. And also we see some trend-related differences, which definitely makes it more important to find the right policy solutions. And just one more note, as mentioned, real wage trends are important. However, as the OECD highlighted as well, the profit rates or the markups should also be studied, as there might be record increases in debt rates as well, as showed in Hungary. There were a few, and this is also part of inflation and the inflation story, which we should somehow put to our models and try to understand as well. So how we see, it's a very complex situation that central banks and economic policy decision makers are facing nowadays. but hopefully we will be ready to have the right and needed answers to all these very large challenges we are facing. Thank you very much.
Thank you very much. Or at least we are working on that. This is for sure. So thanks for this very interesting presentation. All these comparisons and the differences and the similarities between the 70s and the 2020s, and also it is also very important to see that different countries can have really different experiences, even if at the global level the situation was quite the same. We can move to the last presentation, but before starting this one, which will be delivered by Speder Balázs Speder, who is a head of department at the Central Bank of Hungary. He will speak about experiences from the last 5 decades concerning disinflation and inflation shocks. I would like to mention that maybe not everybody will be with us after 5 p.m. because, for example, Professor Monet told me that he has to leave. We will accept that, of course. But for the others, I think that it is time to start to think about the potential questions and because we will have the Q&A session after the presentation of Balázs. So Balázs, the floor is yours, and I think that Christoph, you should stop to share your screen because we still see.
Okay.
If you can.
I hope I can. I'm happy if I get an idea here how to stop it.
That's a good question.
I think I can take over.
Okay, that's okay. That's fine. That's fine.
That's the right one. All right. Thanks, Balázs.
Okay.
So floor is yours. Thanks.
Okay. So hi everyone. It's really a great pleasure to be here. And you know it's really hard to be the last presenter after 3 so great slideshows. So I'll try to be quick. This is a joint work with Balázs Vonnák, who is a teammate here at the Central Bank of Hungary, and we are both at the John von Neumann University, as Pali Kolozsipál has already mentioned you, and I'll present one of our last studies, which is basically about inflation shocks and disinflation, and it's essentially a collection of stylized facts from the past 50 years. So here is the agenda for today. First, a couple of words about motivation, even though I think we don't really need motivation because we have already seen this chart today. This is a little bit different because we show the median median global inflation, and it's a monthly inflation for the last 50 years. And the interquartile range as well. So we can see that annual rates exceeding 10%. In nearly half of the countries of the world in 2022, and this is pretty much a rare occasion, which happened only 4 or 5 times in the last 50 years. In the next slide, I pointed out 4 of these shocks. 2 of them are basically the oil price shocks, where inflation rose to double digits starting in 73. And also in 79. So this chart shows T is basically which we kind of identify as the start of rising inflation. And this is shown by the light blue and the yellow. And then the dark blue shows the global inflation rise in just before the global recession in 2008, 2009. So we basically, in this chart, we do not show the post-1990 inflation, which was kind of geographically more constrained for the post-Soviet Union and post-socialist countries. So we basically here focus on these 4 occasions, which I have already shown in this slide, that these are the biggest inflation surges in the last 50 years. So now inflation is persistently stuck above the targets, and even though it's coming down in most of the countries, I've just been to Austria last weekend, and all the newspapers were still covering like inflation being above 7.8% in Austria, and they are freaking out that this is super huge, and they are far away from the target of the ECB and from any kind of measurable well-being for the people. So what can we do about this? What can we learn from the past? I think that's a natural question now. So our research is basically trying to generalize and create stylized facts of these global inflation shocks since the 1970s. We try to see under what conditions does a quick disinflation take place, and also, which is the most important thing for people, what's the real effect of this disinflation. If we go a bit more technical, this is the sacrifice ratio. So that's the cumulative loss in the GDP. What can we tell about the sacrifice ratio, and what is the role of central banks in determining it, or what role they have in driving sacrifice ratio? So this is a pretty big literature actually from the 80s and 90s on these things. I will not go through on all of them, but basically moderate and high inflation and the cost of the stabilization of moderate and high inflations is pretty well studied by so big guys like Sargent or Dornbusch and Fischer. There is a Hungarian guy, Darvas, who also wrote a lot about it. And then the second part is like, what are the components of these stabilizations? We also relate to this part of the literature, and then the role of central banks. In addition, and I'll just put this in the last couple of rows on the slideshow, most recently, two relatively similar studies came out to our study. So this is one is an NBER working paper, but it starts only in the 90s. And then there is an IMF working paper, but they have different selection criteria, what you will see in the upcoming couple of minutes. So our approach and our data is basically all the countries of the world. It's over 200 because some countries have ceased to exist. The time span is annually, and it's an annual time span for two reasons. One is to exclude monthly surges in inflation following just simple one-off cost push shocks and also VAT changes driven by governments. And the second one is like because we are checking other macro variables and other important variables which are not existent basically on a monthly level. This drives us to use annual data. Data is in this presentation, it's just 8 variables what we collected, but there is an extended data set I will not show today. So this data set is basically concentrating on the headline inflation, GDP growth, short-term interest rates, government debt to GDP ratio, fiscal balance, unemployment rate, exchange rates versus the dollar, and then the global commodity price index of the World Bank. And our approach is basically just, as I already told you, essentially a collection of stylized facts. We just see and observe the distribution of the evolution of main macro variables. We compare them. We run mean tests to see the difference, and then we run a toy regression for correlation between central bank independence and disinflation. It's important to note there is no identification strategy, so there is no causality presented in this research. This is mainly a qualitative narrative research based on numbers. So we say nothing about the causes of these inflation surges and also not about the causes of the disinflation. So nothing about whether it's due to a cost push shock or due to some demand shock or due to some deliberate economic policy or some favorable exogenous development. So the closest to this research is basically the research dealing with moderate inflation. So moderate inflation is something that's generally in the literature thought to be around 15%, like between 15% and 30%, according to Dornbusch and Fischer. And then there is Easterly and then Bruno, Weg, they put it more in between 20 and 40%. So we kind of go with these thresholds and say, okay, there is a shock. We define a shock at T when the annual inflation rises above 20%. But then we say a prerequisite for an inflation shock is that in T minus 2, so 2 years before the shock, inflation had to be below 10%, and in T minus 1, inflation has to be below 20%. And then the successful cases will be where the successful disinflations will be where in T plus 2, so 2 years after the shock, inflation will be again below 10%, and the unsuccessful cases will be where the inflation stays above 20% 2 years after the shock. So you see, there are 73 successful cases which we have identified and 53 unsuccessful cases. So by construction, we do not deal with cases which are in between, which are neither successful nor unsuccessful. So a natural question would be, okay, by looking at this big sample, we kind of mix together several different shocks in several different countries. So it's not, you know, we also thought about, okay, maybe we are just measuring, or we are just seeing the effect of the 70s, or maybe we are just seeing the effect of inflation and disinflation for the underdeveloped or for emerging market countries. So here this chart basically shows on the left side the successful disinflations, and on the right panel the unsuccessful disinflations. And based on how darkish the bar colored is, this shows the development level of the country, and it's based on the World Bank classification. So basically this shows that, okay, maybe a little bit the lower and low and lower medium developed countries are a bit overrepresented, but you cannot say that high or upper medium developed countries are missing, because like in almost 40% of the cases, it's either high or upper medium developed country, which we can see. So now I'll move on to the first part of the stylized facts, which is the successful and unsuccessful disinflations. So first, here is the chart where you can see the annual inflation in the two cases. And as I told you, successful disinflations, basically they go below 10% 2 years after the shock, and then unsuccessful stay above 20%, stay for 2 years after the shock. So first of all, this is by construction, as I told you, and we miss the cases in between. But what we find striking is that even though the median, so again, this is like the solid lines are always the median, and then the areas, they are always the interquartile ranges. So basically what we find striking is, like, if you check the median of the unsuccessful cases, they do not simply stay above 20%, they still keep going 1 year after the shock, and they kind of stabilize around or above 40%. So like in 50% of the unsuccessful cases, inflation stays above 40%, even 2 years after the inflation shock itself. So then we move to the GDP growth in these two cases, and we can see like successful economies barely have any kind of change in the GDP growth, but unsuccessful, they do have some drop in the economic growth. So unsuccessful economies are already characterized by a slowdown. Here you can see this from T-2 going to T before the spike of inflation, and they catch up pretty slowly. The shades, the areas do not overlap too much, and if you run the tests, they are basically the means and the medians are statistically different from each other. A natural question, okay, but what happens on the fiscal side? So I'll skip now the chart for basically the debt to GDP ratio. So I'll move to the fiscal balance. And for the successful cases, we can see that fiscal balance improves already in the year of the shock and after the stabilization. Basically, this should be, and as I told you, this is not a study of causation, but like rather a correlation. We can just hypothesize that this is maybe because of the increasing VAT revenues, but then it still stays high, so improves after the stabilization. In the unsuccessful cases, fiscal balance deteriorates pretty quickly, and even though these medians and means, if I would show means, they wouldn't be statistically different from each other. Okay, there is a question that someone is seeing only the same slide always. Is it for everyone?
No. We can, it's moving.
Okay.
At least on my screen. So I don't know what's the reason.
Okay. So, but you can clearly see the difference in T+2 between the two medians and also the means. So in 2 years, even though interquartile ranges do overlap in the years of the shock and 1 year afterwards, 2 years later on, basically they are completely different. So they are on completely different track, successful or unsuccessful disinflating countries. Okay, then let's move to the monetary policy part of it. So bottom line is base rate or some short rate is rarely available for all the countries of the world, starting from the 70s. So basically we have like 50% coverage for the 70s and maybe 80% coverage for the 80s. And starting from the 90s, we have coverage for almost all of the world, or all of the countries of the world. So what we can see on this slide after this bottom line is still successful cases do show an earlier and higher rate hikes, or basically the difference and difference in rates than the unsuccessful ones. So unsuccessful ones basically increase rates only later and only maybe just in the period after the shock, but they have to maintain it higher for longer, as you can see in T+2, while successful cases can start decreasing their rates even after 1 year the shock happened. So then a natural question would be, okay, but maybe these events, maybe these charts and what we can observe is basically just driven by exogenous shocks, like oil shocks, like Professor Ferrara has shown in the first presentation. So what we see here is like this is the run-up of the global commodity prices, and actually the price index itself. And this is taken from the World Bank. And again, the chart shows like basically for unsuccessful cases, it's irrelevant what happens in the global commodity prices. So, but for successful ones, it's also kind of helping in the surge. So like it contributes a lot to the surge in inflation, but it also helps a lot in disinflation. But for unsuccessful ones, it's practically non-existent. So last, I'll move to the cost of disinflations themselves, and the big question in these, and I think the big question in these high inflation periods, which is pretty hard to catch, is how can this high inflation persist after a one-off shock? How can it be that the radical one-off rise in price levels, the price level itself, leads and transmits into a persistent rise in inflation, and it becomes kind of stuck above 15 or 20 or 25%. So then there is an approach, an old model by Lawrence Ball, who is in Johns Hopkins University, and it's a really nice model about the strong and weak central bank and how the central bank determines the sacrifice ratio. And in this article, and basically the approach is that there are two equilibria. One is a good one and one is a bad one. So there is a credible disinflation commitment by the central bank, and then there is a non-credible commitment. And now it's just basically an easy way how to tell it, because obviously the model is a bit more complicated. But once you have credible disinflation commitment, then that helps in anchoring inflation expectations at low levels, and then that will result in low sacrifice ratio. And the same happens in bad, I mean, the opposite happens in a bad equilibrium. So then the non-credible commitment leads to high inflation expectation and high sacrifice ratio. Okay, but now we can see, but that commitment can determine sacrifice ratio, but how can it lead to having real economic costs. So the natural question is, does this disinflation have a significant effect on the path of GDP after periods of moderate inflation? So then there is a different classification, slightly different compared to the previous ones. And here T denotes the start of the disinflation period. And there we require different criteria than previously and say, okay, we say disinflation. Now we use that criteria if T minus 2 has a minimum level of 20% inflation annually and T minus 1 is still above 20%. And then T should be the start of this disinflation, and T plus 1 and T plus 2 should both have below 10% inflation. And then there will be 65 cases which we can identify disinflation cases. If we move these thresholds to a lower level, because one can say, okay, recently inflation shocks due to globalization are not so big, and then we move the thresholds from 20 to 10% and from 10% to 5%, then we have 92 cases. So basically what we do is now we go with these 92 cases, and I mean, 65 and 92 cases. And in both cases, we find basically 35 or 65 occasions where average growth rate in the following 2 years is basically higher than in the preceding 2 years. And this would mean here down, you can see the two charts. So basically on the left side, you see the stricter threshold where disinflation happens from above 20% to below 10%. And on the right panel, you can see disinflation happening from above 10% to below 5%. So what's striking is basically, obviously this is more striking because on the right side, it shows that GDP growth is fairly constant if disinflation happens from 10% below 5%. And obviously this is a median, so you can imagine cases where GDP growth goes this way or the other one goes this way, and also the shaded areas are just interquartile ranges, but still it's kind of a pretty stable line is what we can observe here. And on the left side, which is the stricter criteria, we can see that there is basically no significant real economic cost in reducing the inflation. This result is, by the way, consistent with Easterly and Bruno, but the temporary slowdown found by Ball is not present. And also, I have to admit that most studies do find real economic costs being present for inflation moderation or disinflation periods. So where is this discrepancy stemming from? Maybe from different time spans. I will not list all studies, what time span they use, but basically our study is using the longest time span for 50 years. Maybe it's because of the number of countries observed, because some people just focus on emerging markets, some people just focus on developed or kind of highly developed countries, and maybe because of the definition of disinflation, because a lot of studies only use percent changes as criteria, saying that 2% change or 3% percentage point change in inflation, annual 3 percentage point change in inflation for 2 or 3 years is the definition of disinflation. We kind of say, what's striking to me is we kind of say, we require stricter criteria, but still have no meaningful real economic costs in this study. So then, lastly, and this is my last slide, basically we run a toy regression, and it's really just a toy regression because obviously it's not, it's not a journal level regression, but I like toy regressions because if you can't see anything from a toy regression, then it's basically does not worth to research into. So the partial explanation of this new trust sacrifice ratio is to be found, I think, in central bank independence. So in this regression, the dependent variable is basically the real cost, which is a change in average real GDP from the preceding period to the to the following period of the shock. And independent variables are the central bank independence index by an article published by Romilly last year, and DCOM is the change in average annual commodity inflation from the preceding period to the following period. And what's interesting to see is like model 1 is the model with all observations we can have for successful disinflations, and then we omit Argentine and Azerbaijan because they are super outliers, and there we have model 2 with 2 observations less, and it's still like just 36 as I have shown here. Oh, it's 35, then it's a typo on my side. But anyway, this is 36 observations, and then we see if central bank independence is higher, then the real cost is basically lower. If we put in the commodity price index, we do not see too much, but what's really important is model 4, where we include the interaction term of central bank independence index and the change in commodity prices. And it's important to tell you that the central bank independence index, the average sample central bank independence index is 0.56, so basically 1/2. And once someone multiplies up the betas and adds up the betas and multiply it with the sample average, we can basically see that that the evolution of these cost post shocks does not really affect the cost of disinflation once you control for central bank independence and once you check an average independent central bank. And this implies that in cases where central bank independence is below the sample average, then significant real costs will occur in the disinflation period. And then global commodity price dynamics do not support disinflation. So just to conclude, I'll go quickly through. So in successful cases, we can see that disinflation is characterized by tighter Rican policy and more favorable commodity price development. Interest rates increased faster and started to reduce earlier. Econ growth did not typically slow down in 2 years following the shock. Public debt to GDP level, which I haven't shown here, sorry for that, stabilized after its rise prior to high inflation. In unsuccessful cases, inflation rate stabilized about 40% in half of the cases. Short rates raised lower and later and had to kept higher for longer. GDP slowdown occurred even before the spike in inflation. Yeah, I just skipped the public debt part because I forgot to show that anyway. And regarding the output loss, we can see that disinflation after periods of persistently high inflation was practically painless in most cases. Once you measure output loss and sacrifice ratio with GDP and not unemployment, I'll have to say, and central bank independence increased disinflation commitment and decreased the sacrifice ratio. And then there is a link to this paper if you are interested more into it. And thank you for your attention.
Thanks a lot. You mentioned that your regression is a toy regression, but I think that your conclusions and all the results that you presented were very, very interesting and they're much more than just toy results. But all in all, I think that we are a little bit we have run out of the time that I wanted because maybe just because of the delay at the beginning. But let me open the floor for questions. If you have any, I know it's not easy because all the 4 presentations were very, very hard to follow sometimes, and even if the conclusions were quite straightforward, I also accept that raising questions just after 4 so serious presentations is quite difficult. But if you have any questions, that just unmute yourself or raise your hands or do whatever you can in that Q&A session. If you are hesitating, let me raise the questions that I have. unfortunately, Professor Monet had to leave the meeting, but just let me ask one question to each of the presenters. For Professor Ferrara, I just would like to, your presentation and your study was about the supply shock and the oil shock and how monetary policy has to respond to such a shock. And I also accept all the results that you presented that was essentially for developed countries. But I just would like to ask your opinion about the secondary effects and the importance of secondary effects. But because even if the oil shock is coming from the supply side, it has an impact on inflation. And if we do not try to decrease the inflation with monetary policy, that can have negative secondary effects. Concerning the presentation of Christoph, I just would like to ask what is your opinion concerning all these difficulties that we are having right now concerning debt sustainability and financial stability issues, how all these problems and difficulties will make the work of these global central banks harder, or how can they really fight against inflation with all these difficulties? And for Balázs, let me just ask a question about an expression which is quite often used nowadays, which is polycrisis, saying that it's okay that fighting against one crisis is quite. I wouldn't say that's easy, but it's quite okay. It's manageable. But nowadays we are living in an era of polycrisis, that we are having a lot of crises at the same time. So we have inflation, we have debt sustainability problems, we have financial stability problems in the banking sector, we have the climate change, and we have inequality issues, geopolitical stories, etc. So, do you have any experience based on the past crisis that we can use in such a complex world that we are living in right now? And let me give the possibility to respond to Professor Ferrara, because he has to leave in a couple of minutes as well. Thanks.
Yes, thank you, Paul. You can hear me? That's okay?
Yeah, we can hear you.
Okay, so yeah, thanks a lot. That's a good point. Talking about second round effect. So yeah, honestly, I have no deep insight on this based on the literature. At least what I can say is that if you look what's going on today, that is in spite of the rise in interest rate, both in the US and ECB. In euro area, we clearly see this transmission. So it means that currently it seems that we have a core inflation that is likely higher than headline inflation, and we have also something which is interesting, is that we have inflation in services now that tends to be higher than inflation for goods. At least in France. I don't know about euro area as a whole, but for France, this is what we have recently. So what I mean is that in spite of the rapid reaction, we still have second round effect. So we don't have the counterfactual that without any strong ECB reaction, what would have happened? I don't know, maybe a stronger reaction, but that's a good point. I don't have in mind any research papers trying to specifically focus on this point. That could be very enlightening for the current situation. I agree, because indeed it seems as, at least in France, the situation that I know is that we have this transmission from we have a second round effect, clearly. So if you have in mind any good papers on this point, I would be interested too.
Yeah, I mean, we have a lot of research on that here at the central bank as well, so we are working on that issue. But okay, maybe that can be a really interesting field for future research as well. So thank you very much for being with us. I know that you have to go, that's why I'm saying that. But for you have still 5 minutes, and
still 5 minutes.
If you stay with us, it's a great pleasure, and thank you very much for accepting our invitation. So,
Thank
Christoph, maybe I can give you the floor if you want.
Thank you very much. I think this is the big question for all the central bankers and policymakers all around the world. And what is interesting, I think, is that it's not anymore just an emerging market issue. This is definitely the main question for developed economies as well. As I see, just as mentioned, the different policy tools should be well coordinated. Inflation will be very important in this process, and everything became just more complex because this is also a question about the world economy flows and the world policy flows as well. So if globalization changes paths, then inflation will increase. That definitely should result to further rate increases, and that makes such a situation with the debt levels almost impossible to be well financed. The easy textbook answer would be just to try to grow out, so make the productivity increased, which is very difficult. And I think there is a very limited path just based on the past 50 years to that. So I think some not that easy solutions should be found. So there are some a bit more costly things like restructuring, or even I think it's a very good idea what Professor Goodhart suggested, that partially we should move from debt financing to equity financing. And there are some very out-of-the-box ideas regarding public finances on that sense as well. In private, I think it's easier to manage it and find the right solutions for it. And of course, also a very socially difficult situation. What textbook would suggest is higher inflation, which I think we central bankers do not like at all, and we would like to avoid this pass in the solution box. So I think this is very difficult, and I definitely believe that it's not only emerging but also developed economies that are facing very difficult public and private debt situation regarding sustainability, and possibly, or it's also a possibility that basically the way we are thinking currently in economic policy as a system, or in regimes, I would say, should be changed because of that. So somehow there are too many targets for economic policy that just cannot be achieved at the same time. So in this sense, I'm a bit pessimistic, but hopefully there are a lot of people who are decision makers and well above my pay grade who can find out the solutions for this.
That's true. I mean, yeah. But it is quite sure that the road ahead of us is quite bumpy. That is for sure. It's not an easy period that we are facing right now. So Balázs, what we can do with the poly crisis?
I'm a pretty bit unsure about the specificity of the question. So, are you referring to like the poly crisis as being something that hinders our understanding of the world in such a simple manner? I have shown.
No. I'm just saying that people think that nowadays we are facing a poly crisis, which means that we are a lot of crises at the same time. Yeah. It's like a little bit quite the same question that I raised to Christoph, because we have all that question related to the debt sustainability, financial stability, but also climate change. And it just to simplify my question, it's much easier to fight against inflation if you do not have that climate change problem. So maybe your answer will be that history doesn't give us any valuable insight about that, but maybe we have some we can learn from the past from that point of view as well.
Okay, so I would be rather happy if Christoph would have got this question, because I think he's better in polycrisis, but I'll try my best and answer this. So basically, one thing about polycrisis, what I think about polycrisis is like, this answer starts pretty far from your question. So I think people read what they see. People started reading many news. The information coming in today's world is much like the volume of information coming in today's world is much higher than previously. And then there is a behavioral aspect of this, and we call this availability heuristic. And I think just because super huge volume of information is available, people tend to read more about it, and they tend to focus a lot on issues which are sometimes irrelevant. So I remember when I applied for PhD programs, we always told to each other that no news is good news. And basically, I think this saying kind of lost the word. And there is no news. There is every day some news. So people think we are living in a negative world. People think we are living in a very bad crisis in all sense, because so many information is available about it. And sometimes I feel like this polycrisis is kind of, overhyped, so to say, and be on the other part of the word. But anyway, if I go to answering this polycrisis thing from more a historical perspective, as far as I remember, back in the interwar period, there was a lack of social insurance system in the United States, a complete lack. Okay, today it's still not the European type of social insurance system, but back in the interwar period, there was a complete lack of social insurance. And the New Deal, which kind of solved the Big Depression, basically not just solved the Big Depression of the 1932 Big Depression, but it also solved the social insurance system, which was missing. So sometimes if you have a polycrisis, you feel like you have a polycrisis, you have many interconnected crises, but sometimes one solution for one crisis generally solves a different crisis as well. And it's kind of, a buffer mechanism, I would say. And once you start solving one thing, the other one solves itself as well. So like also, I have to say, maybe if you go to the Second World War not just solved the nationalistic problems of Europe, or maybe not just solve the fascist part and the right-wing part of the world and kind of put it where it belongs, but it also brought us decolonization. So basically, Second World War is what brought us decolonization, which would have never happened without World War. And we cannot deny that decolonization was needed for 70% of world population to start flourishing ever since. So I'm a bit skeptical about polycrisis, because I see one solution for one issue in a polycrisis solves another problem as well.
No, absolutely agree with you. I didn't want to go in such, deep in the question. I just have this impression, and that's why I raised that question, that we are talking about polycrisis because it's really topical. It's quite, it's like fashion, saying that we are living in an era of polycrisis. But maybe if you look a little bit more in detail concerning the 70s, for example, we can also see that maybe that period was also quite complicated and with a lot of crises at the same time. So maybe polycrisis is, on the one hand, as you said, is a little bit, too much in the news, and on the other hand, it's not something really new, maybe. So this is something that we are having for quite a long time. I do not really want to abuse anyone's trust and patience, I have to say. So that's why I think that maybe this is the perfect time to finish our conference. I think that was a wonderful afternoon. with very interesting and very, very relevant presentations about something that is really important for central bankers and everybody who is interested in economics and the political economy, actually, and geopolitics. So I'm really happy that you were here, including, of course, first of all, the presenters, but also the audience, because I think that that was a very, very good possibility for all of us to share ideas with each other, and that was really, really interesting and thought-provoking, I think. Just to conclude, I just would like to say that thank you very much, and I encourage everybody to check the website of the Hungarian Economic Association, because we have quite a lot of programs, not only the section of finance, but all the sections are very interesting. But of course, before all the section of finance, and also I would like to highlight that we have here at the Central Bank, we have a quite interesting and very, very good journal, which is the Financial and Economic Review, and you can find articles and papers about these topics also in that journal. So thank you very much for your attention and for this wonderful afternoon. Thank you very much.